Okay, we are live. Hello, everybody. Vincent Priest coming to you from the Naples Vice channel here in beautiful Naples, Florida. It's Sunday, and what a fascinating Friday we had in the S&P 500. Closing price of the S&P 3240, only up about 11 cents. NASDAQ actually went red. Coming back down to around 9,000, Dow 28,645. So not a lot of change. We actually in the S&P for the first time, because we had a pretty big gap. They gapped them on close to 6 points on the S&P, and considering the fact that they sold them off back down through that gap, and they couldn't hold it, tells me that this market's looking a little toppy right now because we have had quite a rally, as you all know, over the past. Things aren't loading. Whatever. Over the past couple months, I mean, really just a tremendous rally, and we've had periodic pullbacks, but nothing to the extent that would lead you to believe that we're getting any kind of a correction. Because every single pullback we've had has gotten bought. When we had one, I believe we've only had like one since Thanksgiving. And really, it was nothing to write home about because it lasted for 3 days. You look on the weekly chart, and it really just amounted to nothing. So considering that fact, we gapped, and then they kind of consolidated the S&P all day, and I'm talking cash right now. Futures looked even more ugly. Big fat shooting star closing inside the prior day's range, which usually is kind of ugly. The only thing right now, you got the S&P futures up about 4 points. But Sunday night, I don't put a whole ton of weight in because the U.S. Stock market, cash market, hasn't had a chance to digest everything that happened over the weekend. One other fascinating thing, we're talking all technicals here because on the news front, there hasn't really been a great deal of market moving events over the holidays, and things like that. So not a lot of action from there. Now, could we see something from the president this week? Sure, but he hasn't really said anything this weekend. It's more about the impeachment. And I follow him on Twitter, actually. It's kind of ironic. And I get updates every time he tweets, which gets a little annoying sometimes, but it saved me in the past. There's two fascinating figures that I think really should be addressed in that regard. We did have the NYSE trend, which is kind of a measure of buying and selling, popping way above 1. So when you're going above 1, that usually means that there's bearish sentiment. There's a lot of selling going on. Now, the trend is more of an intraday. Usually don't use it for longer term trading. But the fact that we got a nice pop on Friday, I think is somewhat of an indicator that perhaps maybe we got a little bit of sellers coming in here. Another thing is that we had a pretty solid move on the VIX. And you might hear them talking about on the news about how, there's people buying a lot of puts and blah blah blah. Well, that's what the VIX measures, is a measure of option premium, basically. So they were buying quite a bit of options on Friday with the VIX coming up. Critical levels, we're coming up to 1 right now in the futures. Continuous contract of the S&P. 32.41 3/4 is a setup trend line. Because we did get that drop and we took out the 32.38 area. The little gap on the open, okay, a couple of points. I don't put a lot of weight into that. Massive volume candle coming into the close last Friday, but they did close the S&P futures down 7 points, which is fascinating to me. Skew, which is a measure of call options to put options continues to be pretty high. You got a 140 29, so we still have a lot of call skew. There's still a lot of people long this market right now. And markets always find equilibrium, and when we have a lot of longs, an excessive amount of longs, they come in and they clean them out. We do have the first of the year coming up, and this has been a pretty big subject amongst a lot of traders, especially here on YouTube. And basically, all the hedge funds and everybody is rushing to get all these stocks on their balance sheets are coming in here, and then they're going to dump them at the beginning of the year. Well, I think that one of two things is going to happen. And I can't say which one. I'm not going to sit here and tell you that I know for sure. But you remember, the market screws the most amount of people possible always. I mean, that's just how this thing works. 90% of people lose money playing this game. And it's true. I mean, always. That's how this game always has to work. So the thing that I think is going to happen is we're either going to have, and I think this is maybe the most likely because we have so many people on this market, is that we get big sellers before the first of the year. Remember, the first of the year is on Wednesday, so we have 2 days before that. I think they come in and kill these longs before the first of the year. That's my opinion, because we have such a heavy weighting to the long side here. The other scenario, and I think this is probable as well. I mean, I don't think it's quite as probable, but they're going to come in and wreck a bunch of the shorts, because you got a bunch of people like me that want to, buy puts, short this market right now. And when we get some evidence that it's time, we're taking trades, small trades at that, because when we're doing contrarian type of trades like this, I don't like to put a lot of weight behind them. I like to get some cheap, out of the money puts, that can give me about a 500% return, which, if you've ever traded the S&P to the downside when the VIX is pretty low, I mean, you can expect that. But I like to stay really small here and keep my risk kind of low, because the second scenario could stay true. They could continue to rally this thing past this week until all the big guys, all the people on Wall Street return from the holiday, which would be, I think, next Monday is the 5th. That's when everybody's going to be coming back, all the big shots at all the institutions, all the ones that are going to be reallocating their portfolios. So that's another scenario. And I think it's good here when you're shorting this market to make sure that, while you're keeping your position size, you have a little bit of flexibility. You're getting a little bit longer duration with the options. I like the weeklies, because I like trading the 4-hour chart. But in this case, I think you might want to go out 20, 30 days, at least to the end of February, because it totally could happen. I mean, they could come in and they could just run this thing higher. And if we have small risk and we get burned, I'm not, too against risking 100% of what you pay for the option, because if the return is going to be 4 or 5 or 6 times, okay, then that is right in line with kind of that risk to reward model 4 to 1. So I always risk the premium, at least the majority of the time, unless I find out I'm wrong sooner. But I always assume the risk is the full premium that I pay for that option contract. Aside from that, we did have bonds. They're buying bonds quite a bit. I got a little wrecked on bonds last week. I thought that they would sell bonds off a little bit more than they did. Well, I was wrong. That's part of it. And I had options on the 5-year, the 10-year, and the 30-year. So a good chunk of the curve all short. Puts out of the money, low risk, high reward kind of situations, where you're buying a contract for $250 and you're looking to make $1,000 or more. Because they do that in the bond futures. I've heard of it. I've never done it myself, but it's definitely an opportunity out there. Well, they rallied the bond futures last week, and we were coming down. I mean, they were right around that on the 10-year, the 128, which, that's okay. It happens. All my options expired worthless. That's fine. It happens when you're playing for big gains. Sometimes you get taken out of your positions, and that's okay. But bonds, really were catching a rally, and the volume started coming up a little bit here on the 10-year futures. I like to trade the 30-year, but I like to use the 10-year as the reference because that's the most liquid of all the bond futures. And the 10-year, anywhere you go, Yahoo Finance, any of these big shot people that you might listen to all day for news, they're always going to be talking about the 10-year. Everybody talks about the 10-year bond. That's the standard. And, they use that for calculating mortgages, blah, 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 et cetera, et cetera, et cetera. The 10-year is always the bellwether. Another thing I like to watch is the yen futures, which caught a little bit of a bid. The yen has been in kind of this range here for a while, and the yen is not a primary. Like if we're looking at comparing haven assets, the yen isn't always one that I'm really, really paying attention to. But if I see the S&P is looking a little weak and they're starting to buy a lot of yen, I think that can be a kind of a signal, just like watching bonds, just like buying gold, watching gold, etc. And speaking of gold, gold really has rallied. It's had a beautiful rally here. I'm looking to buy some gold on a pullback. I think we have enough evidence now that gold is breaking out. We had a 9 print actually on the gold daily continuous contract, which did print a setup trend around 1505. We're sitting at 1517 right now. I think that's a sufficient pullback. I'd be okay with that. Buying around 1505. Nice even number. Setup trend line, which is beautiful. And we actually have setup trend resistance to the upside too at, 1518. So if we pull back and we break above 1518, gold's off to the races. 1600, I think that'd be reasonable. I don't see why we couldn't do that when you look at the previous rally running from, about 1270 area up to 1570. So we had about a $300 rally in gold. Could we see another one? Yeah, maybe. I think it's going to depend on China. It's going to depend on what's going on here with the equities, what's going on with the Fed, and just endless money. The people on Wall Street, the Federal Reserve, and here's the conspiracy thing, but it's true. They don't like gold going higher. They don't. And I'm going to let you do your own research to figure out why that is, because this channel isn't about, gold rigging or whatever it is. This is about trading, and, we don't talk about all that kind of stuff on this channel, but there's other great people that have proven that it's a reality. Last but not least, the euro had a big breakout. Big breakout. And I haven't really been doing a lot with the currency, so I haven't really been following exactly why that is. You broke the 112 area, which had been staying solid, really going back to October, and it had a big breakout back there. What was the reason? I would imagine that probably has something to do with the repos, but I could be mistaken. When you're looking at DXY, has been getting clobbered, kind of going a little bearish. I would imagine that maybe it has something to do with the year-end unwind. The dollar has rallied. At the end of the day, the dollar has had a little bit of a rally this year. So I would imagine it probably had something to do with that. Soybeans, having a pretty still stellar time. The only problem I see here with soybeans, though, is that we are coming up to a massive downtrending resistance area going all the way back to 2016. Big. And they couldn't quite get up there the last time. So Do we break above there? I don't have a word for it. We could. It's possible if more comes out about China and things like that. Soybeans look like they want to pull back out of here. We did have a little red day on Friday with a good amount of volume. So could we have a pullback and coming here soon? Sure. And I like the 928 area for a pullback. Also 918, that was another one I've been watching. We do have a gap to fill here in the beans. 922. Correction, we do not. This is a continuous contract. So when they rolled to, I believe you're looking at March beans now. They gapped it up because they were trading at a premium. So 928, I think, is a reasonable price here in the soybeans, possibly a buying opportunity. We're going to reevaluate, obviously, as things develop with the China situation. If we do break above this downtrending resistance, I think there's a good chance we easily get up to 1,000 on soybeans, which they call it $10. But if you look at a soybean quote, it looks like 940, 140. Otherwise, it would look like 1,000. So, on that note, what are we going to be looking for this week? I think we'll be pretty quiet on the news front. Wednesday, supposedly, is when all these tariffs from China go off, and the president in China are supposed to be talking about, when they're going to sign this phase one deal, and da-da-da-da. We still don't have a lot of clarity on that. I think that could rattle the markets. If we're looking for a catalyst or an excuse for this market to pull back, like most of the media says, they like to say, oh, stocks sell off amid, whatever. That doesn't really matter. I think that could be the better catalyst, perhaps, for a market pullback. If, say, China says, oh, we want to delay, the rollback of these tariffs, or we want to, delay the signing of the phase one deal, and there's some uncertainty. That's all this market would need at these levels for a 50-point correction. And we're going to be watching 3150 as the first area. So I'll keep you updated. Trading is still going to be a little bit thin this week, so we could have some kind of strange price movement out of here. But on that note, I'm going to go ahead and call it a wrap. I hope everybody had a great weekend, and I hope everybody has a great trading week. Let's make some money. From Naples, Florida, this is Vincent Freese for Naples Vice. Have a good one.